And the reason you come to watch here is we're going to continue our topic here on what's happening in the real estate market and obviously what the big banks such as BMO and RBC have to say given the 1% increase in interest rates last week. Also, I'll talk a little bit about the inflation print that we saw this week, very ugly number to say the least, and a little bit about rents and obviously what's going on with the European market. They're actually also raising rates for the first time in 11 years. And a little bit about some sort of shortages that we're facing in the labor market. I'm sure you've experienced it. Obviously, it's a hot topic, so it's not going to come to a surprise to you. Before we begin, if you have any questions for me, you can always reach out to me Instagram and Twitter. My handle will be in the description below. And again, I am a wealth management advisor. I research, I spend a lot of my time, and I do this day in, day out. So if you have any questions, please do reach out to me. But a little bit of this is my perspective, and obviously, the information here in the article. So definitely, this is not financial advice. Work with someone you can trust and someone you believe in. So let's kick it off here. So the first big article here from the Canadian Press from Monday, July the 18th, interest rate hike like a hammer to housing. And this is from a senior BMO economist. I'm sure you've heard his name if you been following him or reading his articles. So kick it off here. A BMO capital markets senior economist says the Bank of Canada's recent move to increase its key interest rate setting up the housing market for an even deeper correction next year. Robert Kaviak says the governor, Tiff Macklem, surprise 1% rate hike last week was like a hammer to the housing market. In a note to investors, Kaviak says the increase, which prompted the commercial banks to increase their prime rates, has made it even more difficult to qualify for a mortgage under Canada's stress test. So those numbers have gone up, and I'll tell you what he's saying here about the numbers. So Kaviak says before the move, variable buyers or borrowers were still qualifying at 5.25%, but that has now shifted to around 6%, which he considers a massive pill for the market to swallow. And for fixed, it's even more than that. So fixed rate borrowers are not qualifying around 7%, which he says will carve into their purchasing power. Obviously, you're able to borrow less. Obviously, that makes a difference in terms of the house or the market price that you can purchase into. Continuing along on that same topic, RBC had a massive article this week. I really took this in, which is from Bloomberg here. Historic correction grips Canada's housing market, RBC says. The housing market correction that's taking hold in Canada could turn out to be its biggest in recent history, according to a new forecast from the country's largest bank. Benchmark home prices could fall more than 12% through early next year from the market's peak. So national home prices across Canada is what they're referring to. A bigger decline than any of the four national turndowns of the past 40 years, according to a report Friday by Royal Bank economist Robert Hogue. Sales are also expected to slump 23% this year and 15% next year, RBC said. The total decline of 42% since early 2021 would outrank the 38% drop in 2008 and 2009. If you remember what happened in 2008 and 2009 was the Great Recession, obviously led by the US. And these numbers and what they're saying here is drastic. We haven't seen this in a long time. Canada's housing market has sharply shifted since the Bank of Canada began raising its interest rates from the record lows in March. The central bank, seeking to rein in inflation that is running at its hottest in 4 decades, unveiled its largest 1-point increase since 1998. That was last week, the 1%. It raised the benchmark rate to a full percentage point to 2.5 and has promised more to come. And this individual's prediction is makers won't stop until they hit 3.25% in October. And obviously, this will send more buyers to the sideline. And we expect this downturn to deepen in the upcoming months. So we're talking about fall and obviously winter, with both resale activity and home prices reaching lower levels than we previously anticipated. So this, I just want to quickly read. There's a lot here. This article will be in the description. The last comment I want to share with you is, still Hogue criticized the forecast as a correction, not a collapse. Given the overheated pace of the last 2 years since the pandemic, a decline from such record levels could start to ease some of the affordability issues, he said, adding that soaring immigration combined with the low likelihood of overbuilding could ensure the market doesn't enter a debt spiral. He expects the correction to be over sometime in the first half of next year, so 2023. So take that in. Tell me what you think. Definitely massive news from both RBC and BMO, and I think this article from RBC says a lot. Correction, collapse, whatever you want to call it, markets are definitely going down. They have been down, and obviously interest rates are going to continue to go up. And this leads directly into the next topic here, which is hot inflation sends Bank of Canada on course for another oversized hike rate. This is from Wednesday, July the 20th. Statistics Canada Consumer Price Index, the gauge of Bank of Canada uses to guide interest rates, surged to 8.1% in June, the biggest year-over-year increase since January 1983. So that's 40 years, guys. That's how how crazy inflation has gotten, how high it's gotten from obviously since the 70s and 80s. Oil prices peaked in early June, as we spoke about last week, and have somewhat eased, suggesting the July numbers will be less severe. However, inflation has spread well beyond gasoline stations. The consumer price index still came up a year-over-year increase of 6.5%. That's after, the subtraction of gasoline. So 6.5% is still quite a bit, just taking out gas. The Bank of Canada's latest forecast has a consumer price index averaging annual increases of 8% in the third quarter and still averaging gains of about 3% at the end of 2023. Obviously, that's way past their target of between 2 and 3%. And inflation is such a big deal, and obviously the print this past week, is evident of that. So more interest rate hikes are on the way. So definitely expect the next one in September, and it's going to continue to cool down the market as we've been seeing. And what's happened as a result of buyers not being able to buy? They've gone to the sidelines. Sidelines mean renting. So this is an article from Reuters here from Friday, July 22nd. Nowhere to live, rents in Canada surge as home prices fall. Canadian home prices are dropping fast after surging during the pandemic, but that is offering little relief for consumers who face skyrocketing rents and fading buyer power as interest rates rise. Desperate would-be buyers found themselves caught in a frenzy of bidding wars for real estate during the pandemic, and now, when home prices rose more than 50% in just 2 years, now the competition has moved to rentals, with landlords demanding months of rent upfront and at times even pitting tenants against one another who will pay more, according to real estate agents and the news in the market. The average rent on a one-bedroom apartment in Canada is up 13.7% from the start of the year. This is from datarentals.ca, with year-on-year rents surging 8.5% in Toronto and 19.2% in Vancouver. The shift from fanatic demand for homes to buy to home to rents makes it clear a broader issue with Canadian housing, that there simply is not enough of it. Higher interest rates are not destroying demand for housing, it's just shifting the demand from buying to renting. As we've been talking about, buyers have gone under the sideline. They obviously can afford less, with obviously interest rates continue going up and expected to go up. So it's obviously put rentals at the forefront and asking for, exorbitant prices, even above pre-pandemic at this point. The demand just sloshes between renters and buyers depending on where rates are, as long as you have constrained supply. So rents have gone crazy. There's a little bit more here. You can definitely read up on this. But if you're, if you're looking for a rental property, please share what your experience has been. Love to hear what's your experience been. Others can learn from it and, give your perspective to the rest of the market. As we've been talking about interest rates, just quickly here, Europe's central banks, bank larger than expected interest rate hike. So this is quickly on Thursday, this past week, the European Central Bank raised rates Thursday for the first time in 11 years. And they're joining steps, obviously, with the U.S. Federal Reserve, and Canada's been on that path for a number of months. There's a little bit here. The move raises new questions about whether the rush to make credit more expensive will plunge major economies into a recession at the price of fighting inflation, which is forcing people to spend more on food, fuel, and seems like everything else these days. So, this is across the board. Everyone's battling inflation, it seems, and everyone's battling, interest rates. And this is the topic of discussion. As we've been talking about recession, as we've been talking about the labor market and interest rates, I want to clear this or share this perspective with you guys. Canada's labor shortages will outlive potential recession. And again, this is our warning from the RBC. This is an article from Wednesday, July the 20th. RBC economists warn Canada's aging population and immigrants working beneath their potential will see the current labor shortage outlive a potential recession in 2023. Canada's unemployment rate fell to 4.9% in June, the lowest since comparable data from 1976. By October, they predict the Bank of Canada will raise their interest rate to 3.25%, and that will tip or potentially tip the economy into a moderate recession. They point to the retiring baby boomer generation, a disruptive labor trend over the past 10 years that they estimate is only about halfway complete in Canada. And By the end of this decade, labor force participation expected to fall to levels not seen since the 70s. This is from The Economist. The lower the labor force participation rate, the more severe the economic and financial strains will be. And as you heard about immigrations, Canada is actively recruiting, skilled immigrants. RB says those with a university degree and above are 43% more likely to work in jobs that don't require this level of education compared to Canadian-born workers. So obviously that difference between being born in Canada and obviously, coming as an immigrant. So this is a video this week, guys. A lot of stuff is happening in the market, a lot of predictions, and we have already seen a cool down in the market. Three things I want you to take away from this video is inflation is running hot. This last week's print is the highest we've seen. It could have peaked as we've seen gas prices potentially go down, but there's more to come here, definitely. Interest rates are definitely going to continue to go up as a result of that. And what does that mean from a buyer perspective and a seller perspective for housing? And obviously you're seeing that with rents as it's been pushed to the sideline in terms of rents going up. Buyers have less opportunity, so it's a battle now for potential rental properties. And third, this is a worldwide battle here with inflation and obviously interest rates, and we're going to see, and I'm going to continue to bring this to you in terms of how this plays out. So I hope you appreciated it. Any likes, any comments, any subscriptions, always appreciated, and continues the motivation that I continue to bring this insightful information on a weekly basis. So I hope you have a great day. I hope you have a great week. Thank you for watching, and I hope you have a good one.